Well, our next guest says that while many investors may believe the stock market has entered a period of calm, he views it as perhaps the eye of a hurricane. Let's bring in David Sekera. He is Chief U.S. Market Strategist at Morningstar. David, thanks a lot for joining us. You see several challenges or headwinds to the market. First of all, what do you think of valuations in the broader stock market right now?
Well, at this point, as much of a rally as we've had since the beginning of April, we're now back in line with our fair values. So technically, the market right now is only trading at 1% to 2% below a composite of the fair value of all the stocks that we cover today. So at this point, not necessarily a lot of margin of safety. So I really wouldn't recommend putting new money into the market today. So we are market weight overall. But I think positioning here is especially important, making sure that you have your market or your portfolio tilted to those parts of the market that we still think are undervalued, and maybe taking some profit in a number of different areas like growth stocks that we think have run too far at this point.
Have investors become numb to the challenges posed by a global global trade war?
I don't think that they're numb, but I think the market is just too sanguine at this point. I think there's a lot of cautious optimism out there, but I think the market is not giving you enough of a discount really to be, taking advantage of that today. When I just look at all the risks that are out there, really it's all the same risks that we had, back even in March and beginning of April that we still need to see play through, and they're not going to play through until at least, the next couple of months. Just taking a look at the risks, we still have all of the tariff and trade negotiations going on. So over the next month, we have to have all the negotiations with Canada, Europe, Japan, India come through. We really still haven't even started with the negotiations with China. Yes, there's been some agreements to agree to a few things we've already agreed to, but they haven't really gotten down to the brass tacks. When I look at our U.S. economy here, we are forecasting that the rate of economic growth is going to slow sequentially over the course of the year. I know FactSet put out an article not that long ago noting that the street has been lowering their second quarter earnings estimates, more than usual. I think the Fed is on pause for now. I don't think we're going to get any help from them anytime soon. Geopolitical risks not any better now than they have been, over the past couple months. And even though we had some good inflation prints here, the past month, I'm still concerned, what's going to happen with inflation once tariffs really start to roll through, and how is the Fed going to conceptualize that when they think about their monetary policy?
What explains the big rally we've seen since April? Markets are forward-looking, as you know. They look ahead by 12 to 18 months. Investors must believe that a year or 18 months out, a lot of these issues will be resolved.
Yeah, but we're just not giving any margin of safety as far as how quickly those are going to get resolved and exactly how they're going to get resolved. Oftentimes it just seems like the market acts like a pendulum, and in this case, we started off the year. We noted that the market was trading at a pretty rare premium, to our fair values. We started the bear market with the AI stocks that were all 1 and 2-star rated stocks, sell off, and then of course we had the Liberation Day tariffs. Market really took a hit after that. Now, by beginning of April, we changed our recommendation. We went to an official overweight. I think it was on April 7th. And the market's been off to the races pretty much ever since Trump put the pause on all of the tariffs. And at this point, I think now the pendulum is starting to swing too far in the other direction.
Okay, you are cautious on markets. What kind of portfolio construction do you advise right now?
We like value stocks. Value stocks still trading at a pretty good discount to a composite of our fair values, trading at about 14% discount. I think if we do have any kind of sell-off over the next couple of weeks as we get closer to those deadlines for the tariffs, value stocks certainly would hold up better to the downside. Plus, they do pay a dividend, so at least you're getting paid to wait, and just overall better valuations. And then I would look to underweight growth stocks. Those are trading at 11% premium, not necessarily the most expensive we've ever seen them, but again, that would be the part of the market that I would expect to sell off further and fastest to the downside if we do get that correction. And then by capitalization, we still like small cap stocks. They're an overweight. They're traded about a 20% discount to a composite of our fair values. I would just note, this is not a trade. It may take a while, may take a couple of quarters, before the market starts to rotate into small caps. Typically, they do better in an environment when the Fed is going to be cutting the federal funds rate. We're not there. That's probably not until later this year, maybe in September. And they also do better when the economy has bottomed out and the economy starts looking like it's ticking upward. Again, we don't think that's going to be until the fourth quarter that the economy really bottoms out and then starts moving up slowly in the beginning of 2026. I just think you need to be positioned there because once small caps start to move, they can move very quickly. It doesn't take that much money to get reallocated out of large caps and into small caps to make that reallocation really move those stocks quickly.
Okay, you've got a couple of growth stocks that have rallied in a big way, and I see you're recommending that investors, if they're holding those stocks, should take some profit. You've also got some stocks that you think are undervalued, and they're both Canadian names. So let's try to get to them in the time we have left. We are running out of time. Broadcom and United Airlines are two stocks that have had huge rallies recently, and you think investors holding those stocks would be wise to lighten up?
Exactly. The old adage, no one ever went broke taking a profit. Broadcom is up 78% from the bottom. It's trading well above our $225 fair value estimate. So I think taking some profit off the table is a good idea there. And United Airlines, that's up 45% from the bottom. It's now trading at a 90% premium to our fair value. Here in the short term, rising oil prices, I think, are going to put some pressure on there. And if we are correct that the rate of economic growth in the U.S. is slowing, that's also going to put a damper on demand for travel here.
And those Canadian names that you think are undervalued. So I infer that you think that investors maybe want to put some capital here. Are Nutrien, the fertilizer giant, and Barrick Mining, the gold and copper mining giant.
Yeah, what I really like about these stocks is that both of them are working. Both of them have had very strong returns year to date, but yet we still think that they're undervalued. Nutrien, last I checked, was up 34%, yet it's still a 4-star rated stock, trading at a 15% discount. It's a company that we think has a narrow economic moat, so it has some good long-term durable competitive advantages. And what we're seeing there is rising sequential fertilizer prices. That's going to just point towards increasing profit through the rest of this year and into next year. And Barrick is probably the most undervalued of the gold miners that we follow. That's a 4-star rated stock. It has been a laggard, in the category. It is a bit of a story stock, but ultimately, the negotiations the company are going through with Mali, where they have some mines, we expect the production probably restarts in the next couple months, which I think will be a good catalyst for that company.
Okay, let's squeeze one more in. This one is a stock that typically would be a growth stock, but it's lagged the rally. Marvell Technologies.
Yeah, this is actually one of our top picks in the semiconductor space right now. I believe it's down 40% year to date. It never recovered. In fact, I think it might even be slightly below its April lows. But I do think investors should be taking attention of this one today. There's been some negative market rumors regarding its AI accelerators losing some share, and I think that's what caused the stock to never accelerate, like the rest of the marketplace. But I believe it's next Tuesday. They have a webinar coming up that they're going to detail their technology for those accelerators, and our team believes that that could be a good positive catalyst for investors really to start reevaluating their view on that stock and hopefully notice that it's as undervalued as we think it is.
David, thanks a lot for a great conversation. David Sekera is Chief U.S. Market Strategist at Morningstar.